going through our lovely new disclosures here. And again, we'll give everybody just a few minutes to join on. All right, looks like we're ready to roll. So, sure, I got everybody logged in over here. Great. Okay, again, welcome everybody to the Wednesday chat. My name is Don Kaufman. I've been with Thinkorswim pretty much since the very beginning here. I love this. People are already on here. They're like, where's Tom? I'm sorry. Tom is short the market, and we're not letting him talk anymore. So especially after today's rally. Imagine that. Futures up 13.5 today there. So take a look at the screen here. Again, futures up 13.5. Pretty amazing. Again, a lot of us here at Thinkorswim, of course, short this particular marketplace. Anyway, that being said, let's go through a couple little details here, a little bit of housekeeping, and then we're going to jump into today's chat. First item that I really want to cover here today. This Saturday, there will be a release of Thinkorswim. I've got a couple new features on there that has been discussed in the past by Tom Sosnoff, but Tom wanted me to let you guys know the release is on for this Saturday. And there are some slick little features. We're able to drag and drop symbols around the trading application. There's quite a new bit of scanning functionality here. So for the very first time, you guys are going to be able to scan in real time, like moving averages crossing over and so forth. So if you want like a 15-day moving average crossing over a 30-day moving average, you want to scan like the entire S&P 500, you're going to be able to do that. And not just moving averages, many of your technical studies, you'll be able to now scan by technical studies. And that, of course, is coming in the new release. So be sure to check some of that out. I've been playing around with it myself all day here on the, what do we call our QA platform. Anyway, let's jump into it here. Okay, so today's chat. About a week and a half ago, I had a client shooting me an email in regards to the Greeks, and I've had a lot of questions about the Greeks. And looking back through our chat archive, we realized that we haven't done a lot of chats on the Greeks here in the last couple of years. So we've decided, let's go with the Greeks. Anyway, so I gave Tom Sosnoff the chat topic of the day. It was Greeks. Of course, by the time, Tom got a hold of it, he turned it into Geeks, Greeks, and, Trade Logic for Expiration Week. We're going to cover a little bit of it and a little bit about Geeks, too. Then again, there's probably 2,000 people in a chat room here on a Wednesday afternoon. We're all option geeks. Hope that's okay with you guys. All right, so let's get into the bulk of the conversation today. And I would have to say, of all the topics that I've taught over the years, and I've been on the road with Tom, for Tom, and for Thinkorswim, literally almost since the very beginning of Thinkorswim. One of my favorite topics to always discuss are these Greeks here. And I'm going to get quite in depth on it. So if you guys don't mind, I'm just going to click this account info button, open up here to a full screen, give you guys a little bit of a cleaner view of my desktop right now. And when I go to this desktop, you can see I'm on this kind of the old layout here. Of course, many of you are familiar with the newer layout where it says Delta, Gamma, Theta, Vega, Profit Loss the Day, Profit Loss the Open. And of course, you can manipulate any one of these columns by just clicking on the wrench and customize your columns. But to make it a little bit easier to see my Greeks, I'm going to return to the old layout for today's chat. And the truth of the matter is I've always liked this old layout. It's simple, it's clean, it lines things up, it's beautiful. Let's go with it for today. Anyway, so what we're going to really cover is we have tendency to find that clientele typically don't look at a lot of their Greeks. And obviously, some of you aren't trading options very heavily. Those of you that are into option and option trading, at some point, you're going to be creating several different option trades and several different underlions. And the problem is when you've got option trades. Like, I've got some trades here in the spiders, and I got some trade in the Qs and the diamonds, and I got something on Apple here, like a nice short position on Apple. That's not working too well for me. Regardless of what the position is here, sooner or later, it's difficult to manage individual trades. So what we're going to start to do is try to cut some of you over to not so much looking at the individual trade, not so much individual profit and loss graphs, but we're going to start looking at aggregate trades via the Greeks. I mean, if you look at this Greek on the monitor screen here, can you really say that, you log on to Thinkorswim every morning, and do you really understand these Greeks in depth? And that's kind of the question. Now, before we get to what this monitor screen does, what it is available, and really where we're going to go with that, I'm going to actually focus on Greeks kind of in a singular sense. And the first thing I always cover whenever discussing the Greeks is kind of the primary logic that we roll out to a lot of clients is about theta. So again, when most people start talking about the Greeks, they really refer to delta initially, but we're going to talk about theta and primary trade logic, and then wrap that in. So what's fun about the Greeks is this is so obscure to so many of our clients, yet you guys are all out there, you're trading options like crazy, but we talk about the Greeks and it's like, okay, it's a foreign language to most people. Yet, when myself and many traders on the professional side first get into this business, we live or die via the Greeks. And that's what a lot of customers don't get. So let me give you the big differential here is most clients are excellent trade finders, and they have a difficult time managing risk. And I've said that on previous chats that I've done in years past. So most clients are excellent trade finders, have a difficult time managing risk. What most professional traders are good at is managing risk. We're just not that great at finding trades. But ultimately, we really believe that managing risk in this business is, it's absolutely critical moving forward. So what the Greeks allow us to do is to more effectively manage risk. And the only way to really describe Greeks, and again, I'm going to jump back into theta here in just a moment, the only way really to get deep into describing these Greeks is simply the fact that if you've ever gone out and you played a game of chess, and most people are familiar with basic strategy in chess, is, how do you really win in chess? Well, looking 3 or 4 moves out. Most good chess players can see at least, or kind of figure out at least 2 to 3, maybe even 4. Really good chess players can see as many as 5 moves out. Ultimately, that is what the Greeks provide us, is the ability to see what our P&L will be as the underlying starts to move. So if you were to take into account maybe this the spider position here, and forget about what the actual option trades are in here. I can click my spider position open really quick and click it closed again. I don't want you to look at the individual position right now. I want you to look at this from what I call the 50,000 foot view, and that's what these Greeks really are. What this Greek really tells you here in delta, and we'll get again back to theta in a moment, is what you're going to make if the underlying moves up or down. And you got to stop and ask yourself, does that help you? Well, what do you mean if the underlying moves up or down? Well, you can say the S&P 500. If these spiders, which is the ETF of the S&P 500, if the spiders were to move up $1 today or down $1, or if the spiders were to move up $2 or up $3 or down $2, down $3, do you know essentially what your profit and loss will be today, a week from now, and a month from now? And I want you to ask yourself that on each and every trade that you put on. The first thing that most clients always look at when they're trading, of course, is how much can I make on this trade? Then you look at your break-even price and you figure out, okay, how much can I lose in this trade? We're going to take it a step further. We're going to figure out how much I can make for $1 move up, $2, dollar move down, $2 move down. And we're going to make it simple, clean, okay, and extremely easy to decipher utilizing some of the Thinkorswim technology. And a lot of this trading application is really built around this logic. And that's missed, by many clients is, a lot of the logic in this platform is so you can very quickly decipher what you have on, what you're going to make or lose for any dollar movement in either direction. And that's, a critical aspect of the Greeks. All right, so we just kind of set the stage a little bit of, hey, why do we teach these Greeks? It's to help us more effectively manage risk moving into the future. Anyway, that being said, let's start with theta. What is theta? Okay, so I've aggregated my theta between Apple and the diamonds and Qs and spiders and TBT, and it comes out to an aggregate 65.44. I guess the first thing to mention about the Greeks is, in the end, the Greeks are dollars and cents. What theta is the daily whittling down of an option's value, and it's completely and totally inescapable. Options have decay, all right? Now, you need to decide as a client in this business what you want. Do you want to pay and go out and buy options and have decay going against you? Or would you rather sell option premium and have theta, okay, going with you? My position in this particular account happens to be positive theta, and that's a logic that we kind of drive out to many clients at Thinkorswim. So when I say positive theta, it simply means I've gone out in these particular positions, sold options in a defined risk manner, and have currently $65 of theta that I'm generating every day. Now, theta is not linear, meaning that, today I'm collecting $65. It doesn't necessarily mean tomorrow I'm collecting $65. As many of you know, time decay, when I say not linear, is exponential. The closer you come to expiration, the faster the options are going to decay. All right. But what also has an effect on your theta is, of course, going to be movement in the underlying price. So for right now, okay, for all intensive purposes, we are collecting $65 a day in decay. And, people always ask, hey, do weekends count? Of course weekends count. There's Saturday, there's Sunday. These are calendar days, not trading days. So $65 of theta a day. So now, if you were to look at your positions, and all things being equal, if nothing at all happened today to your position, but we move forward by one day, you should collect approximately $65. Now, what's surprising to many of you is you're like, well, I didn't quite make $65 today, but nothing happened in the marketplace. All right, okay, this is a best estimate. Now, again, what can affect theta would be changes in the underlying price. Changes in volatility can also have effects on theta. But I think it's just good to get a good grasp and an understanding of, hey, why do we even bother looking at theta? One of the reasons I look at theta is simply how much am I going to collect in decay? And does the amount of decay that I'm collecting, all right, warrant the risk that I'm currently taking? Now, that's another question you're always going to need to ask yourself on every position that you get yourself into is, hey, $65 a day in decay. Is that worth it? Is what worth it? I don't even know what my, my outstanding risk is. Well, that's what we're about to dig deeper into. So that is theta for my entire account's position, collect $65. Now, if I go back to the trade tab, so let's go back to the trade tab over here and we'll type in spiders, and I have tendency to use spiders as kind of my marquee product. And you can see, of course, strike prices are listed down the middle. I've got 14 strikes open over here. I've got theoretical price and delta, but instead of pulling up theoretical price, I'm going to go down to options, theoreticals, and Greeks, and I can pull up theta. And what this is theta in the most singular sense, in that it says, minus 3 cents. What that really means is this option is currently trading for $1.66, $1.69. This option is decaying by approximately 3 cents per day. All right, so that's theta in the most singular sense. And then, of course, if you went out and sold this option, you've got positive theta. If you buy this option, you've got negative theta. Again, all things being equal, we really have promoted over the years to sell options in a defined risk manner. Why? Because we find it easier when clients have theta on their side, taking positive theta trades, collecting the decay in your favor. And of course, if you were to put on a bunch of defined risk option trades, you're going to, of course, yield a little bit of positive theta. And it'll open up like a diamond position here. And it looks like my diamond position's a simple iron condor. All right. Of course, I could highlight the entire iron condor in here, create closing order, and you can see there's an iron condor built into this position. All right, so let's close that up, close up the diamond position, and move right on. So we spent more than enough time on theta. I hope I beat theta to death over there. It's a daily wheeling down of an options value. Again, completely and totally inescapable. Whether you buy options or sell options, you're going to have some decay and exposure in any option trade. You will have exposure to theta. Now, from theta, I'm going to jump back over to delta. And if you guys don't mind, I'm actually going to start to key in directly right now on a spider position. I don't want to worry about the aggregate. I don't want to worry about Apple and diamonds and Qs and spiders and TBT. And you'll also see something here in a minute, and I will cover this at the end of the chat today, is that I am beta weighting my entire position. So for those of you in TOS chat land right now, if you've ever been curious about what beta weighting really is, I am going to get into beta weighting also in detail. And the other thing that I always mention whenever I do these chats is, so you guys know, I speak fast. Today I've actually slowed it down, so if you want, I can speed it up a little bit more for you. But regardless, of course, these chats are archived right now, so by all means, this is a chat, and I'm going to tell you guys this. You could listen to this chat 4 or 5 times. You're always going to pull more stuff out of it, because the Greeks, they don't sink in right away. I mean, these things take a little bit of time to kind of acquire not only knowledge of, I mean, people understand what I'm talking about. It's really taking that knowledge and applying it. So it takes a while to get to that application stage in the Greeks. And, why the Greeks are so important to me, and again, is I have tendency to go out, this position on the spider. So I'm going to key in on this position of the spiders I was mentioning a moment ago. And I've got basically $32.75 of theta that I'm pushing forward. So that's positive theta. It's decay in my favor. And I've got negative 31 deltas. Now, why is it so important for me to look at my Greeks? Because now I'm going to open up my spider position. So I have purposely put together quite the convoluted spider position. Looks like I am long 500 shares. Got 10 of these, 10 of these, 10 of these, 10 of these, a couple of 5 lots rolling in here. Looks like I even overlapped a couple of strikes. I've definitely got some kind of calendar spread embedded in here. This, again, is a nice convoluted position. So why such a convoluted position? When I go out and trade, I consider myself more of an inventory manager than just a trader out there. I go out, I put on a lot of inventory. I like to spread my inventory out over numerous strikes here, and collect as much theta as possible. Now, I don't want to give you guys the perception that I'm not taking directional risk. I am taking directional risk in this particular position. And we're going to talk about in just a few minutes here the difference between, being long delta, short delta, or what they call delta neutral. If you guys have ever had those questions about delta neutrality, we're going to cover that also. So this is the primary reason I'm forced to look at my Greeks now, because I can't figure out every single trade in here. So what I do is I just pack them all together in one nice little ball and look at them, and they're negative 31 deltas. So let's get into what delta is to you and what delta means on this monitor tab. All right, in my position statement, delta means something very different here in the position statement than it does over here in the trade tab. So let's actually start with what I call the 50,000 foot view. This is negative 31 delta. Okay, what that simply entails is if this particular underlying, which is the spiders, moves up or down $1, I'm going to make or lose basically 31 bucks. And you got to stop right there and say, okay, time out. Are you comfortable with that amount of risk? Are you comfortable making or losing $31 for a $1 move in the spiders? I mean, that's not an extraordinary amount of risk. I mean, most of you guys, I'm here in Chicago right now. I think I paid $30 to park today. I've got more risk in the parking garage than I do in this particular spider position. And, when you look at the spider position, and I'm negative 31 deltas, but I'm also collecting $32 a day in decay for having taken some of that directional risk. And that's, again, what we're going to start to make correlations to in here in just a moment. So back to the trade tab over here, and let's drop into delta. Okay, so I gave you, again, the 50,000 foot view there in the monitor tab, but now let's get into a singular sense of what delta really is. And this is where, I love teaching the Greeks, because there's so many different facets for just delta alone. Okay, so let's get into, again, delta in a singular sense. When you look at delta here in the trade tab, and the delta of this 124 call, so it's a Spider May 124 call. There's 37 days left until expiration. There's a 28 delta. What does that really mean? It means as this stock moves, okay, up or down $1, this option is going to make or lose 28 cents for each dollar move. All right, so let me give you another one. Delta. What's the general definition for delta? Delta is the rate of change of the option for every dollar move in the stock. So I know you guys are all feverishly taking notes out there, but delta, again, is the rate of change of the option for every dollar move in the stock. Now that's one definition for delta. So let's go through kind of an example here. In fact, I'm going to pop right up here. This is the 123 call. It's got a 36 delta on it. So what does that really mean? It means if this stock moves a buck up, this option is currently trading for around $1.20. What'll happen is if the stock moves up $1, the option will go from approximately $1.20 to what? $1.20 plus 36 cents. And I hope that makes sense. All right. So that is if the stock were to move up $1. But what happens if the stock moves down $1? Well, then it's $1.20 minus the 36 cents. Okay. So that's delta in a most singular form. Is delta, again, is the rate of change of the option for every dollar move in the stock. Now, let's take it a step further here. When you go out and you trade options, okay, options are quoted on a per share basis, but you can't buy one share, you got to buy a contract. Now, we're back in options 101, pretty exciting for you guys. So if we go out and buy one contract, this option doesn't trade for, $1.20. One contract costs you 120 bucks. However, what is critically important here is simply this. When you go out and buy one contract, it makes you long or short delta. When you buy this 123 call, it's going to make you long equivalent to how many deltas? Well, what happens is you buy one contract, it moves the decimal point over 2 places, you're going to be long, net long, what we call 36 spider deltas. So, okay, what does that mean? I'm long 36 spider deltas. What 36 spider deltas means is when the spiders move up or down $1, you're going to make or lose 36 bucks. Okay, now let's get down and start drilling even deeper into this. Delta, okay, everybody assumes that delta refers to options and options only. It does not just refer to options. Stock is delta. And you go, well, what do you mean stock is delta? Of course stock is delta. What do you think the delta on any stock is? Well, here on the spiders, if you buy one share of the SPY, you have one delta. If you buy 500 shares of the spiders, you have 500 deltas. Okay? So when I go out and I buy one contract to the 123 calls, it's making me net long 36 deltas. What's really happening is the option position that I have created is mimicking 36 shares of SPY right now in time. So it helps you equate what your risk is on this particular trade. You say, well, hey, would I ever go out and buy 36 shares of the spiders? And you're like, yeah, man, that's nothing. That's only $36 for a $1 move in the spiders. And, hey, the spiders move today, $1.36. I can handle the pain. Now, here's where we're going to have a lot of fun with this. The very first time you guys went out and traded options. Some of you guys are just trading options for the very first time right now. Okay. Very first time you went out and traded options, you didn't know. Everybody goes through the exact same learning progression. What did you do? You went out and you bought options. And you bought options, and the options that you bought were like at the money or very slightly in the money or slightly out of the money. Let's just say this. You went out and bought options, and the options that you bought had, let's say, here's a fun one, a 44 delta. And how many contracts did you buy? Well, you didn't buy one contract because one contract would make you net long 44 deltas. But instead of buying one contract, you bought 10. So now if you've gone out and you bought 10 contracts of the 122, okay, the 122 calls, that made you net long 440 deltas. So what does 440 deltas really mean? Well, hang on a second. Forget about delta for just a moment. When you went out and you bought that option, you paid basically, let's call it, $1.70 for it. You went out, you bought $1.70 for it, and you said, okay, I'm going to get out of this thing when, the option hits $1, or I'm going to get out of this thing, when I double my money. That's fine. You set yourself profit and loss goals on it. But you would have realized those profit and loss goals may have not been that viable if you had actually understood delta, because in the end you're going to make or lose $440 for every $1 move in that underlying. If you were to buy 10 contracts right now, this 122 call, you would come back over here to the monitor tab and it would literally say like 440. Now, what's the reality of that? You bought 10 contracts, just 10 contracts, all right, of one option. You had 440 deltas of risk. And when you buy the option, okay, when you went out and bought this option, what do you think your theta is going to be? Your theta is going to be negative, all right? Anytime you buy an option, of course, you're going to be losing what? 3 cents a day, but times 10 contracts, it'd be pretty significant there of the loss per day. Okay, look at my position here. I've got basically 32 deltas of risk. Look at all the option trades I've got on. I've got 500 shares of stock, right? I've got 500 shares of stock. I got a 10 lot, a 10 lot, a 10 lot. That's 40 contracts, 50, 60, 70, 80, 90, 95 contracts plus 500 shares of stock. So I have the equivalent of almost 100 contracts on with nominal amounts of directional risk incurred, collecting about $32 a day of decay. And again, this is, maybe your position is not as, convoluted as this one, but that's fine. I just wanted to make a point with this, that the average customer, when you first get involved in options trading, takes a lot of risk. I mean, that's the point I like to make when I go through the Greeks is, most people didn't, understand the exposure when you first got involved in options. And that's really where we're at right now, is just explaining the exposure from a Greek perspective. Now we're going to have a lot of fun with it and kind of move on. So we gave you one definition for delta. Delta, number one definition, is the rate of change of the option for every dollar move in the stock. The second definition that we gave for delta is really your aggregate risk, meaning that if you buy one contract, this would become 44 deltas. If you bought 10 contracts, 440 deltas. So that's the second definition really for delta, is that delta is your directional risk incurred when you kind of put it on a contract by contract basis. And the third definition now for delta. So what's the third definition? You'll see on this, on the calls. Let me change theta. Let's just change theta over to probability of expiring to not confuse anybody right now. But let's take a look at the delta on all the calls. On all of your calls here, delta, of course, is positive. If you look over at my put side, all the puts have a negative delta. So I want you to think to yourself, whenever you buy a call, you want the market to go where? Up. All right? So whenever you buy a call, you want the market to go up. Whenever you buy a put, you want the market, of course, to go where? Down. Well, we're not necessarily going to go out and buy a call. Let's say we went out and sold a call. If we sold a call, we're not long 36 deltas. We're net short 36 deltas out there. So remember this. Buying a call produces positive delta. Selling a call produces negative delta. When you buy a put, buying a put produces what? Negative delta. When you sell a put, if you sell a put, you're bullish. Selling a put, bullish, would produce positive delta. Come back over here to the monitor tab, because I want you guys to start to equate this in your head. You'll see that many of the positions that I have created here, look at this, Apple, negative delta. Diamonds, negative delta. Qs, negative delta. Spiders have a very slight negative delta. And this TBT position is it's just a nominal position as it stands, but it's a very small positive delta. So ultimately, what does it mean when I'm negative delta? It means I want the market to go where? Down. These are bearish positions. They're absolutely slightly bearish positions in here. And, when I put these positions on, some of them, the intention was not to necessarily be bearish, okay? But the market has substantially moved against me in that, well, we've had a little bit of what we like to call here at Thinkorswim a rally. In fact, today was quite brutal to the upside if you guys were short. So, it's the irony is... I love this. Somebody on the chat already chatted in. They said, you must be talking to Tom. Allow me to tell you, I came from a line of traders. I've had family trade on the floor, an uncle trade on the floor, cousins trade on the floor. And listen, I was born a bear. I don't know exactly how it happens, but pretty much you come out of the womb, you're a bear. And some people were asking on the chat earlier also, I've disappeared for like the last couple of weeks because we just had a baby, and when my baby came out, I'm hoping she's a bear. It's too early to tell. She's only 6 weeks old, but I'm hoping she's a bear. It's something that just happens pretty much at birth out there. Not just a bear. I'm also like the contrarian logic here, but our directional bias, I'd love to say this about directional bias. Our directional bias, I don't think should have a big influence on your trading. And the reason is, I know, Tom gets on here for the last 9 months and he goes, I'm a bear. I'm always a bear. Of course he's always a bear. He's a contrarian. When we rally, you tend to get bearish. But the types of positions that we put on allow us to sustain our bearish position without getting completely annihilated. However, today was a very painful up move because we've been trickling to the upside. And trickling to the upside is like, it's Groundhog's Day every single day. However, the bearish position, is not necessarily a bad thing. Why is that? as long as you're collecting enough theta to offset the directional risk you're going to incur, it's not the end of the world. And you can see I've got a very small bearish position here in the spiders, but I'm collecting $32 a day in decay. So let's go back and discuss just a little bit more about delta, and then I'm gonna drill really the Greeks and the hierarchy of the Greeks into you guys as we move forward. So I want you to guys theorize going out and building a position. And by building a position, I mean, so you go out and you're a trader, and you might go out and you might sell 10 of these. So if you sell 10 of these, what are these? The 124 calls. So I sell 10 of them. What does that really make me? Well, it makes me net short, not 28 deltas, but if I sell 10 contracts worth, I'm net short, so I'm negative 280 spider deltas. All right, that's the equivalent of being net short 280 shares of this particular stock. Now, on top of that, so I went out and I sold, okay, the 124 calls. Then you turn around, for instance, and you buy the 125 calls. So if I sold the 124s, I bought 10 of the 125s, what now is my aggregate delta risk? Well, if it's negative 280, okay, but then you went out and bought 10 of these, and that makes you what? That makes you net long 210 deltas. Well, the aggregate is negative, of course, 70 deltas. So I went out, you sold the 124s 10 times, you bought the 125s 10 times, you're net short what? 70 deltas. Then you go out and you, for instance, sell 10 of these, and that makes you, it's, you're negative 70 deltas over here, but then you go out and sell 10 contracts, and it makes you positive 300 deltas. And if you guys are doing the math and you sell 10 of these and buy 10 of these and sell 10 of these, and before you know it, your position becomes so convoluted that you're forced to go right here and to look at the aggregate directional risk incurred by your position. And that's what the monitor tab was really and always has been designed to be able to do, is to look at this aggregate risk. So I own 500 shares, and I intentionally in this position put 500 shares in here to make you guys realize that 500 shares truly is 500 deltas. And all the other directional positions I've incurred in here, and all the other option positions, and these, just so that we're clear, every option position in this particular account is defined risk. The only reason I've got some decent amounts of margin tied up here is that I currently am long 500 shares of stock. And yeah, that did tie up a little bit of capital there, being long 500 shares of stock. So as I close this up, and the reason I close it up, it's easier here, and you can see the market's still kind of meandering a little bit after hours. So I'm negative 30 delta. All right. So what that really entails is, if this market starts to move in the spiders, I'm going to make or lose 30 bucks in either direction. Now, which way, again, do I want the market to go? Well, if you're negative delta, of course, you're going to want the market to go down. So let's assume that tomorrow, all right, I'm just going to make this a real easy example. The spider position only has 30 deltas of risk in here, negative 30 deltas of risk. Easy example. Tomorrow, the market opens. Let's say the spiders go down exactly $1. So if the spiders go down exactly $1 at the close tomorrow, what do you really make? Well, if the spiders go down exactly $1, you're going to make what? $31 in directional movement, correct? Because I'm negative 31 deltas. If the spiders go down $1, you're going to make $31. Great. On top of that, you're also going to bring in theta. And your theta is an additional, we'll call it $32. So all things being equal, assuming volatility didn't change, we're not going to worry about gamma just yet. All things being equal, we're going to make about $64 for a $1 down move on the day, assuming that volatility doesn't drastically change out there. Okay? Good stuff. All right. Now, moving right along from Delta. And I hope you guys got a pretty good perspective of what Delta now is, not only in a singular sense, but you got Delta from that 50,000 foot view. Because when we put this all together here in a couple of minutes, and we will put it all together, the first time that people see this on one of these chats, they're a little bit, taken back at this point. You're like, what am I ever going to use this for? Don't worry, I'm getting there. All right. This is all building towards the infamous Analyze tab. Ooh, it's going to be scary. All right. So the next thing I'm going to cover here is we're going to step forward from Delta. And I'm going to come into, of course, our favorite here is Gamma. So why even bother Gamma? And I'm going to spend not that long here on Gamma because Gamma has been made very much simplified by good technology. What gamma is so you've got delta, and we've got all these different definitions for delta. In fact, there's even one more definition I'm going to add here for delta in just a moment. But so we've got delta. Delta is the rate of change of the option for every dollar moved in the stock. The second definition for delta is delta really is equivalent to shares, meaning that, you buy one contract to this 125 call and it makes you net long 21 deltas. The next definition is delta, either positive or negative, right? Delta being positive, of course, you're going to want the market to go up. Delta being negative, you're going to want the market to go down. And the final definition that I'm really going to drill into you guys for delta is loosely associated with probability of expiring. So if I were to pull up, I'll switch back from gamma for a second. And if I were to pull up probability of expiring, you'll notice that probability of expiring and delta are almost one and the same. So, clients over the years have been like, hey, why did you guys put probability of expiring and delta on the platform? The real reason is, well, you guys asked for it. And when I say loosely associated, the reason I say that delta and probability of expiring are loosely associated is because one of you listening out there is probably an engineer or a mathematician, and you're like, well, no, it's solved by a different equation. I agree with you. However, over the years, most traders use delta as probability, but because we have clients that are engineers, we actually solve for probability of expiring. So I want you guys to know again, you can utilize delta, just this singular sense, as roughly a probability of an option being in the money by 1 penny or more come expiration. So yeah, I love that. Not an exact science. Reading the chat and speaking at the same time, it's fantastic. Let me tell you, you guys put on some hysterical comments. When I am at home, I'm not based out of Chicago. I'm based out of Scottsdale, Arizona. When I am at home, I actually listen to the chat. But remember, we don't listen to what Tom says. I just like reading what goes on in the chat over here because I know what Tom is going to say. He's going to say, I'm bearish. Here's some new really cool technology, right? And that just summed up basically the last 9 months of Tom's chats. I'm bearish. Here's some cool technology. All right. Anyway, moving right along with that one. We'll switch probability of expiring back over to gamma. What is gamma? Gamma is the rate of change of delta. So real singular sense, how this kind of works, very simple. When this underlying starts to move, for the first dollar this stock moves, this option is going to be affected by 28 cents. For the next dollar it moves, it's going to be affected by 28 cents plus or minus whatever the gamma is. Okay, so if I go back to the monitor tab, which I will in a second, you have to think that although delta is the rate of change, gamma is the speed at which that rate of change will start moving there. So gamma is really the acceleration kind of delta. And gamma, and this is going to be very fun to explain here in a moment because part of today's talk was Greeks and part of it was expiration trade logic. Gamma is going to tie beautifully into expiration trade logic. And before I do go over to this monitor tab, I want to close up May and open up the April options here for just a moment. And I want you guys to see some of the gamma curvature starting to break out. What this basically means is if you take a look at this at the money option, we're 2 days away from expiration here, gamma will absolutely explode coming into an expiration cycle. So if this is your first exposure to gamma, you're looking at delta. You go, oh, okay, well, the delta is only 25. Well, what does that really mean? It means this option here, it's a cheap option, right? Option's only trading for like 20 cents. What can happen is if you buy the 122 calls, those 122 calls can go from 20 cents. If that stock moves up a buck, they're going to over double, okay, in price. They're going to go from 20 cents. They're going to jump all the way to about 45 cents almost instantaneously. And from there, it's just extreme. What you have tendency to get is right before expirations, options are going to move very erratically. The reason being is the gamma is explosive. The gamma is driving the delta. So what is critical to understand that in every option, by expiration day, all options have a delta of 1 or 0, period. On expiration day, all options have a delta of 1 or 0. If an option falls in the money, the delta drives to 1. Why? All options that fall in the money, even by 1 penny or more, okay, turn into stock. All options that fall out of the money basically are vaporized. They expire, of course, worthless, which is beautiful if you're a seller of premium. The risk, though, that clients take on expiration week is extraordinary. Can you imagine if you had a position on and you were short these options? If you're short the 122 calls, think about the amount of risk that you're really, ensuing there in the last 2 days to make what? A whopping 20 cents. It doesn't make, logical sense to hold on to short option positions that are anywhere near the money coming into expiration week. Because if the underlying were to move, it will literally tear your position apart because of what we call the negative gamma risk incurred. Now, with gamma, we are going to go right over here, of course, to our wonderful monitor tab. And we're going to look at, again, theta being $32 a day. We've got about a negative 30 delta. Now, what's fun about the spider position here is spider position currently doesn't take a lot of directional risk, but that's for a $1 move in either direction. What's going to happen is if the spiders move $1 right now, you're going to make or lose 31 bucks. But if the spiders move over $1, what's going to happen is this little gamma column is going to come slamming into the delta column. So where do I really want the market to go? Well, I want the market to go down. And if the market goes down, what am I going to make or lose in this position? If the market goes down $1, I'm going to make $31 in directional risk, right? For the delta I'm taking. But what will then happen is this position here in the spiders is very close to what we call delta neutral. What delta neutral really means is it's not really taking at this time any directional risk. Now, that is not to be confused with not taking any risk at all. This position definitely is going to exhibit fairly significant risk. It's just not taking any directional risk. When the underlying starts to move, it will then, again, take directional risk. I think that there's this perception out there in the retail trading world that, all these professionals are trying to get delta neutral. And that's not true. Professionals do take directional risk. They just take it in measured amounts and weigh it against what kind of theta they're collecting, in essence, to take that particular directional risk. So they ask themselves, hey, listen, if I'm willing to take, let's say, 200 deltas of risk, how much theta am I going to have to collect, to offset some of the directional risk that I am incurring? And there is no perfect number. You're not going to sit at home and figure out the perfect number of theta to how much directional risk you're incurring. And the reason being is theta is going to be growing exponentially as you come closer to the expiration cycle. All right. Now that, we ain't in Disneyland anymore. Okay. Now we're starting to take off into the outer stratosphere of what the Greeks really do. At this point, when we start talking about gamma, I always kind of back away and say this. There is an easy way to figure out what your gamma risk and what the effect of gamma risk will be on your individualized positions here. So I don't have to get too deep into gamma because we find that a lot of clients get a little confused around gamma risk. The one key element of gamma is simply this. If you're a client that likes to go out, you like to sell iron condors. If you're a client that likes to go out, you like to sell vertical spreads, use calendar spreads, any one of these strategies, seriously consider closing out your short option trades about 4 to 10 calendar days prior to expiration. That's kind of an ideal setting to be able to close your position. And remember that you can go out, you can close the position, you can buy back your short options there, and then you can, of course, initiate positions for the next month. So there's always been an argument that people say, well, listen, if I have an option and I'm pretty sure it's going to expire worthless, why not let it expire worthless? And I've gone over that fight for years. You guys are going to do what you want anyway. That's fine. But it's in your best interest for me to sit here and tell you should probably close your short options prior to expiration. The reason being the negative gamma risk in the last approximately 4 days of an expiration cycle, meaning this: the directional risk that you incur in the last few days of an expiration cycle drastically outweigh the amount of theta that you can collect. So what happens is right before an expiration cycle, gamma explodes, which is directional risk explodes all over you in the last 4 days, and yet you think you're collecting a lot of theta. The reality is you're not collecting enough theta to offset the directional risk you're incurring. That is typically, all right, the talk that I like to have when it comes to gamma. And so at this point, people's heads are at home, and you're basically they're exploding at this point. So I'm going to go over to the Analyze tab and kind of back away from some things for just a moment here. Let's just hit Reset Slices. See, delete all my simulated trades in here. Now, what I want you guys to take a look at, I'm just going to delete this slice out. I want to delete this slice out. Okay, I've got about negative 30 deltas. Go to the Monitor tab here. Take a look at my Monitor tab. Negative 29.82 deltas. Take a look at my Analyze tab. I'm negative 29.82 deltas. So what I'm asking is, the Greeks here in this Analyze tab are identical to the Greeks found here in the Monitor tab. So jump back to the Analyze tab. Why bother bringing you to the Analyze tab? One of my favorite features that is on Thinkorswim is simply the ability to set slices. So if you guys have played around in the Analyze tab, in fact, you see this, the profit and loss graph. I'm not big into profit and loss graphs. When you first start trading, you go out, you learn a vertical spread, you've seen a profit and loss graph and a vertical spread. You go out, you see an iron condor, saw a profit and loss graph of an iron condor. Unfortunately, look how many positions I have in here. The profit and loss graph becomes a little bit misleading when you start mixing multiple months here. I've got some May options, I've got some September options, I got 500 shares of stock. This P&L graph is, it's a little out there. So I'm going to cover that up for a minute. One of the best ways to assess my risk now, having this big aggregated position, is to come over here and go set slices. And go set slices, $0, $2, and $5 out of the money. Let's go ahead and click that. What that basically does is it now infers what my risk is going to be right now, which is live in time. It actually tells me approximately what my risk is going to be if we move up $2, up $5, down $2, down $5. Now, when we started the chat earlier today, we talked about what's the primary logic. Well, the primary logic is looking at the Greeks. The Greeks provide us a little bit of insight to our future. So what's your future? Well, the future of this underlying is, I bet you anything, this underlying either stays flat, moves up $2, up $5, down $2, down $5. If you look and understand your Greeks, you can see what your future is. You can see different moves into the future. Okay. What that also does is, I know some of you are like, well, I don't care what my delta risk is. I want to see what my, profit and loss is. All right. So if we move up $2, I'll make $243. If I move up $5, I'll lose $440. We move down $2, I'll make $329. We move down $5, I'll lose $564. Now this is based on a derivative model. It's based on a stenciling model. People are like, well, what model should I use? It doesn't matter. All right, the models are just that. They're approximations, they're models. They're relatively accurate until the point which, volatility changes, which, you can do all that and you can simulate all that, but that's not important for today's talk. What is important is now I can theorize what I'm going to make or lose for either direction. But these Greeks that I've laid out and this profit and loss that I laid out, that's for today. Now I want you to ask yourself, what is my risk? I don't know. Let's say, today's the 14th. What's my risk by the 28th of April? And just click there, and now it shows me my risk in either direction by the 28th. And then I'll sometimes take this before I go on the road. And this is one of the few features that I utilize on the platform in terms of analytics. And I actually take this and I click on it and I go, all right, let's go ahead and either print this, or I don't really print it. What I do myself is I snap a picture. So I snap a picture of it and I keep that picture kind of on my desktop there. I'll just close that up. And, you can make like notations and say, listen, when the underlying goes up so far or down so far, I'm not willing to sustain that amount of risk. Okay, so let me reset all the parameters in here and take a look again. You got to determine what amount of delta is comfortable for you. All right, and I like to break down delta once again to shares. Are you happy being long 433 shares of the spiders? I mean, does that make you guys comfortable? And most people are like, well, no, that makes me feel like I want to get sick. I'm like, well, all right. Then at that point, you can do something against your position, in essence, to be able to mitigate risk. And we've done chats, I've done chats personally in the past that have really talked about how to physically go out and to mitigate risk of this, position. And that's not what today is about. Today is about getting you guys to the point that you can read Greek, all right? And that you can look at the Greeks and say, I know where I stand in the world right now. I know where I stand in the world if we move up a couple of bucks, down a couple of bucks, up a lot, down a lot. And listen, this is preset slices. These are preset slices, $2 and $5 out of the money. You don't have to use that. You can actually come right in here to mode, right click on mode. That's a right click on the mode and go price mode. I want to go $10 out of the money, and see now what my risk is, $2 and $10 out of the money. It becomes fairly extraordinary. And then you can, right click on the $5 down and say price mode or percentage step, or even get into sigmas and go, what will I lose if we have a 2 sigma move to the downside? It's fun stuff, okay? Or what will I lose if we have a $10 down move and it's pretty catastrophic losses because I'm long like 500 shares of stock. All right, so with that in mind, let's bounce back over here to the monitor tab and teach one more aspect in regards to the Greeks. And aggregation here is simply this. The position that I was just talking about in the Analyze tab was strictly dealing with the spider. Well, you guys typically have more than one position in your account, or you have more than just the spiders, which brings in the ability to beta weight. Okay, so what is beta weighting? And again, we've done some chats on beta weighting, but again, I'm going to try to take it to the next level here when it comes to beta weighting in the Greeks. And I hope you guys aren't ready to shoot yourselves out there, because the Greeks, this is by no means probably like the most exciting chat you guys have ever heard, but I hope it helps in the risk management side of it. I've always liked teaching the Greeks because I see the Greeks, when you can get a customer to understand an iron condor, and any client out there to understand an iron condor, I think that's a major milestone. When I first got involved in the business here at Thinkorswim, it was in 2000, and I had come from the trading world, and in 2000, I'm basically sitting there and I'm talking to Tom Sosnoff. This is before Thinkorswim ever really started, and he goes, "Yeah, we're gonna have a trading application." He goes, "Our trading application is gonna let retail customers put on iron condors." And I was like, no way. There's no way you're going to be able to teach a retail customer about iron condors. All of a sudden, you fast forward a couple of years, we got customers firing off iron condors. They're legging iron condors. We even got like risk-based margin built into the system. And now we're out there and we're teaching customers, aggregate position management, utilizing the Greeks and beta weighting. It's, to me, the Greeks are the final frontier for the retail customer. I mean, there is no advantage that a professional trader has on the retail, over the retail customer anymore. In fact, I'll give you, 20 different reasons that you want to be a retail customer. You got better technology, you've got fast execution. I mean, I can go on forever. And, understanding these Greeks, it's not 100% essential, but you understand this Greek, this Greek picture right here. This is the final frontier. I mean, this is what professional traders rely upon to mitigate their risk. They've got server farms built to help them aggregate their Greeks and help them manage it throughout the day. And part of this Greeks and the final picture here is simply this. When you first log on to Thinkorswim, it defaults you to the monitor tab here, and you look at your delta, and you're like, okay, the delta of Apple is negative 61, and the delta of diamonds is negative 118. But I want you to be careful, because you cannot add up deltas of Apple to deltas of diamond to deltas of Qs. See, the thing is, not all delta is created equal. It's basically delta is equivalent to shares of stock. So you can't say that 61 shares of Apple is the same as 118 shares of the diamonds. They're completely different shares. So there is a way to equate one underlying into another, and that is called beta weighting. Now, let me explain what beta is. Beta is relation to the S&P 500. What that basically means is beta is relative movement. The S&P 500 always has a beta of 1. No matter how fast or how slow the S&P 500 is moving, the beta of the S&P 500 again is 1. So on each individual stock, and we'll type in Apple here for a second. Each individual stock has a beta associated with it. You can see the beta here in Apple. Let's close up the options. The beta here in Apple is 1.566. What that simply means is this. If the S&P 500 has a beta of 1, that means, very simply put, when the S&P 500 moves up or down by 1%, Apple typically moves 1.5%. Okay? And Apple typically moves with the S&P 500. Once in a while, you'll find an underlying that has a negatively correlated beta, meaning that when the S&P 500 moves up, that underlying moves down. For the most part, beta, okay, is relative change of your stock versus the S&P 500. So again, S&P 500 has a beta of 1. Sometimes you'll see some wild stock that is like a beta of 3. What that entails is when the S&P 500 moves up or down 1%, that particular underlying typically moves approximately 3% up or down. Beta is not calculated on a daily basis. Betas are actually spread over a year. So back to the monitor tab, what we can then do with the beta calculation on thinkorswim is we can then make a relative, adjustment to change Apple shares into Diamond shares and Diamond shares into Q shares. But what I want to do is find a common metric between all of these. And what I'm going to do is I'm going to beta weight. If I check off here, not weighted, check off beta weighting, I'm going to type in this particular position, Spider. Why? A lot of my risk in this particular account I believe to be S&P 500 heavy, meaning that, the diamonds, the diamonds are the Dow, so the Dow is encompassed inside the S&P 500. The Qs, I've got a decent sized position here in the Qs, but regardless, there's still most of the NASDAQ 100 is encompassed inside the S&P 500. And of course, Apple Computers, it typically moves in tandem also with the S&P 500, and TBT is the odd man out, but it's a small position anyway. So what I just did is by checking off beta weighting, I turned Apple deltas. It was 61 Apple deltas, where the reality is that was an Apple deltas. I changed my Apple deltas into Spider deltas. Now this is where the talk gets really fun. Apple deltas into Spider deltas, fun stuff. And it turned into negative 194 Apple deltas. Aggregating the entire position is the equivalent to negative 436 Spider deltas, collecting approximately $65 a day in decay. Obviously, this position is negative delta. If the underlying were to move down, the underlying being the Spider's down $1, you'd make approximately $436. Okay, also collecting about $65 a day in decay, and I'm taking some pretty serious amounts of negative volatility risk here. It's about negative 170 in terms of Vega. And Vega will be the final Greek that I really kind of cover a little bit today. All right, so now that I've beta weighted everything and give you a little explanation of beta weighting, how does that help? Well, we're going to jump back to the Analyze tab. And once again, I've got Apple plugged in here, but let's go ahead and type in the Spiders once again. Pull up my Spider position, and you can take a look at the profit and loss, and I'm going to reset all my slices. Okay, so you saw me hit reset slices. Forget about the P&L graph just for a second. What I want to do is check this from show all to hide simulations. That's hiding all simulated positions and just showing live positions, so hide simulations. Then I will change over my entire analytics tab from single symbol to portfolio beta weighted. What that is going to do now is it's going to bring up my Apple, Diamond, Q, Spider, and TBT position and aggregate it for me here in the Analyze tab. So it shows me my live Greek risk here in the Analyze tab, up 10% or down 10% risks. But I'm going to go into set slices to $2 and $5 out of the money. What that now basically just did is brought up my entire aggregated position on thinkorswim and broke it down in terms of spiders and approximated what I am going to make in the aggregate position if we moved up $2, up $5, down $2, down $5. That ultimately is where the Greeks come into play. Again, better vision for the future out there. And you can see profit and loss here. Obviously, I had quite a little short position going. I'll lose as much as $2,700 with a $5 up move in the spiders here, and that would be today. But I can also go ahead and start fast forwarding the date and start to theorize what my risks are going to be into the future. And you don't just have to go a few days. I can take this calendar and push it all the way out to very close to like May expiration. Maybe the week before May expiration, you can see profit and loss here is going to change drastically coming into expiration. You can kind of theorize this is not such a bad position unless we start going up significantly again, which what is exactly what has happened. Okay, and then you can take these slices. For those of you that are technicians, you can take the slices and set slices over to your charts and actually bring slices up in the charts and kind of zoom in on that, and you can see some of the different levels of where we have to be. And no, these are not Fibonacci's or anything like that. All we're looking at here is, what happens if we move up $2, up $5, down $2, down $5, and putting those slices directly to the chart to kind of say, hey, where do I really think we're going to go based on, price levels. And you can actually see that the price levels will come up. And if you want, of course, you could kind of print this out and write in, or you don't even have to print it out. You can actually make a notation directly here in the charts by simply right-clicking, adding a chart, any kind of comments, add single drawings like a text note. You can come in here and say, that's doomsday. Actually, doomsday wouldn't be to the downside for me; it would be to the upside. So I'd want to drag that out there. Anyway, back over to the analytics tab. That really was the basics of the Greeks that I wanted to cover today. Now, on top of that, we will take. I'll try to take a kind of a couple of questions here as we go, but I also want to get to a few other features, and one last Greek, of course, which is going to be Vega. Let me go to the trade tab. Let's cover Vega a little bit and then answer a few questions as we go ahead. One thing that gets confused quite often when I talk to clients and emails and so forth is what Vega is in volatility exposure. So if you guys don't mind, I'm going to take my information layout, come to options, theoreticals, and Greeks, and actually change it over to Vega. What this really means is 15 cents. I'm going to switch delta to theoretical price because I don't want to confuse the issue too much. Vega here is 15 cents. What 15 cents really means is it's your sensitivity to changes in implied volatility. Now, the far right-hand side of the screen is your implied volatility. All right, so there's what we call the imp vol. What Vega really denotes is how much this option is going to make or lose for a 1% change in volatility. And when I say 1% change, I mean going from 1650 to 1750 or 1650 down to 1550, it will make or lose about 15 cents. Now, the confusion with volatility and Vega exposure is simply this. Options, okay, that have longer periods of time. This is a very critical aspect of understanding volatility and understanding options in general. The longer period of time, okay, meaning a further out expiration cycle, options have considerably more Vega risk or more volatility risk the further out in time they are. So if I were to look at the April expiration, there is little or no volatility risk inherently in an option that is close to expiration. Whereas the further out I go in time, if I go all the way to a September option, you'll see that I've got 31 cents of volatility risk. Now, why is this important? Because you are considering going out and doing a calendar spread. And I've got a calendar spread on, and I've got one on in the spiders. I've gone out and I've put on a calendar spread. What's so important about this? My calendar spread that I have on happens to be in May, September, meaning that I'm short the Mays, and this one's pretty far out of the money right now. I'm short the Mays, and I'm going to open up 4 strikes to make this easier. Okay, I'm short the Mays, and I'm long the September options. And it's actually a put calendar. So let's just surmise that I had on like a 120 put calendar, selling the May 120s, buying the Sep 120s. Now think about this. This position, okay, by selling the 120s, you're short 15 cents of Vega. By buying the 120s, you're long 31 cents of Vega. What this in effect does is makes you net long 16 cents of volatility. And you're like, whoa, 16 cents of volatility. Yeah, but if I do one contract of it, that makes me net long $16 of Vega. What does that mean? It means if volatility starts to go up, I'm actually going to make a little bit of money. If you're long $16 of volatility for one contract, for every 1% volatility moves up, I'm going to collect $16. You go out, do 10 contracts, now you're going to make $160 for every 1 point move up in volatility. What's important about that is, listen, iron condors and vertical spreads make us short volatility. If you believe right now that volatility is going to go up, you should possibly look into the calendar spread, because the calendar spread is a phenomenal way to get net long volatility. And if you look at my position is short Vega. And how much Vega is it short? Meaning that my position will actually work for me if volatility were to go down. However, if the market goes down, volatility could in effect hurt me. However, if the market does go down, I've got a hedge here. I'm going to make some money if the market goes down because I'm short delta. So what I have is I'm really playing one Greek against another. And this is, again, gets out there, it's pretty esoteric. This is the 50,000 foot view of what option traders look at every single day, is trying to create the perfect picture in terms of Greeks. And listen, I'm happy with the position I have on here. I'm making $65 a day in decay. I'm taking 436, negative deltas in terms of spiders of risk. I'm short a little bit of volatility. Hey, if the market explodes to the downside, I'll get nicked a little bit here for volatility. But in essence, I'm going to make it back considerably because I've got a decent amount of negative delta in there. And lo and behold, I'm going to collect $65 a day regardless of what really happens. Anyway, I hope that kind of, rambling on through all of these Greeks here helped you guys out a decent amount on this. This is a chat that, again, we'll archive here in the next couple of days that you guys can listen to time and time again. The other thing is, really try to get a grasp a little bit for this Analyze tab, and just the fact that you can set slices $2 and $5 out of the money, because, clients that have a better view of what's going to happen to their position as the markets move, okay, it's, just exponentially helpful to you as a customer to be able to figure out what your risk is moving into the future. Anyway, that being said, enjoy the release this weekend. If you guys, again, if you are a little bit of a technician, I think you're going to enjoy the release. So this weekend, go into the scan tab, and you're going to see this, the stock hacker is a little bit redesigned. And with that, you can go in there and you can actually do scans on specific groups and say, well, I want to find a moving average crossing over another moving average, or, hey, I want to know when any stock in the S&P 500 crosses over its 50-day moving average. And you're going to be able to do that. You'll be able to say when the 50-day crosses over the 15-day moving average, and so forth and so on. All of those scans are going to be available here within the stock hacker. I would have to say that was one of the coolest features that I've seen. And if you guys haven't played with it, also one of my favorite features on Thinkorswim. And I haven't been on these chats in a while talking about this, but I'm a big advocate of this Think on Demand. It's fantastic. You can pull data from days past. One other feature is on the new release this Saturday, the active trader side of Thinkorswim. This active trader application will be available in Think on Demand, meaning that you're going to be able to simulate the full active trader application within the Think on Demand world. So with that being said, thank you guys very much for joining us on this Wednesday afternoon. I'll be in Chicago again the next couple of weeks. Hopefully, if you guys want, give me some ideas for a few topics, shoot them into my email, and I will definitely try to come up with another good topic. And I'll probably be back in Chicago in the next 3 or 4 weeks and join you guys for another Wednesday chat. Anyway, feel free to chat in some good topics for upcoming session for me doing in the next couple of weeks. Thank you guys very much, and bye-bye.